Imagine waking up tomorrow, just rolling over to grab your phone off the nightstand and seeing 85 missed calls from your lead engineering team.
Oh man, that's the ultimate nightmare scenario.
Right. It's stomach dropping. You rub your eyes, you open your email, and you realize the absolute worst case scenario has actually happened. Every single Windows laptop in your global enterprise is blue screened. Your cloud servers are locked. Your supply chain logistics they are completely blind. You're losing millions of dollars every single minute.
Yeah, and at that point, you're not thinking about corporate synergies anymore.
Exactly. In that terrifying moment, you do not care about your IT budget. You do not care about procurement cycles. You care about survival. And today, we are looking at the two absolute titans fighting for control of that exact moment. Welcome to Griffonomics, where we conduct financial investigations to define the risk before we look at the reward. Today, we're diving into the cybersecurity titans Palo Alto Networks and CrowdStrike, trading under the tickers PANW and CRWD. Both giants are aggressively pursuing the consolidation of corporate security budgets, with PANW leveraging its platformization strategy to force legacy replacement, while CRWD utilizes its frictionless single-agent architecture to dominate endpoint and module-based cross-selling. However, this strategic war creates a structural divergence, as PANW trades at a value-oriented SCF multiple, while CRWD commands a premium growth multiple that leaves zero margin for error in its execution.
That really is the crux of the whole war right there.
Yeah.
It is a massive land grab for the entire corporate infrastructure.
Yeah.
But like you said, they're doing it in completely opposite ways. Palo Alto is pushing this platformization, which is a mouthful, I know, but they want to take over the whole network.
Right.
And then on the other side of the ring, you have CrowdStrike with this frictionless single-agent architecture. They want to dominate from the endpoint up. And, whether you are an enterprise CIO making a vendor decision today, or if you're an investor trying to allocate capital, you have to understand this divergence. Palo Alto is this cash-gushing value compounder, and CrowdStrike is this premium growth machine with literally no room for a single mistake.
No room at all. And to really grasp the sheer scale of this architectural warfare, we have a massive stack of data for today's deep dive. We are tearing into Palo Alto's Q3 2026 earnings, CrowdStrike's Q1 2027 earnings, all their Form 10K filings, the technical white papers, and the strategic presentations from both management teams. We are going to distill all of that down. Because if you sit in the seat of an IT manager right now, you're witnessing something historic. I mean, we aren't just selling antivirus software on a CD-ROM anymore.
No, definitely not. This is structural warfare.
Yeah.
But to understand why this war is happening right now, we really have to look at the foundational problem both of these companies are trying to solve. And that problem is fragmentation.
Vendor fatigue.
Exactly, vendor fatigue. If you look at how corporate cybersecurity has been built over, say, the last 2 decades, it's entirely piecemeal. A company buys a firewall from vendor A, right? Then they buy an endpoint protection agent from vendor B. Then they need identity management, so they go to vendor C.
And then cloud security from vendor D.
Right. So over time, this enterprise ends up managing 30, sometimes 40 different point solutions. It's a complete mess.
It's like, okay, think about building a security system for your house, right? But you hire 30 different contractors who absolutely refuse to speak the same language.
That's a great way to put it.
One guy installs the window alarms, another guy puts in the motion sensors, and a third guy handles the cameras. But when someone breaks a window, the camera system doesn't automatically turn on because it's completely disconnected from the window alarm. They're totally separate systems.
Yeah, and in the enterprise world, those disconnected systems create massive data silos. And in cybersecurity, data silos create latency.
Which is deadly.
It's fatal. When a piece of malware enters a network, an analyst has to manually check the firewall logs, right?
Yeah.
Then they have to pivot and cross-reference that with the endpoint logs, and then check the cloud logs. In a world where modern cyber attacks are happening at literal machine speed, human latency means you've already lost. Both Palo Alto and CrowdStrike recognize that this Frankenstein-style architecture is completely obsolete. The future belongs to consolidation. Enterprises want one single pane of glass. But how they achieve that consolidation is where the conflict lies.
And that's exactly where we need to start. Before we even look at the balance sheets, before we talk about free cash flow margins or stock multiples, we have to look at the physical foundation. Like, how do these technology architectures actually dictate their business models? Because if you don't understand how these products are physically deployed inside a company's network, none of the financial math we're going to talk about will make any sense.
It really won't.
Let's start with Palo Alto Networks. You read their strategy, and the buzzword that just flashes across every single earnings transcript, every slide deck, is platformization. But let's strip away the corporate jargon for a second. What does that actually mean mechanically for a network?
Well, platformization is basically their overarching strategy to cure that exact vendor fatigue we just talked about.
Mm.
Their approach is to walk into an enterprise CIO's office and say, look, you have 40 different tools. We're going to replace all of them with 3 massive world-class pillars. The first pillar is called Strata. This is their network security arm.
Okay.
Now, historically, if you go back 10 years, Palo Alto made its name selling physical, ironclad firewalls, literally metal boxes that sat in corporate data centers. Strata is the modern evolution of that. They are transitioning those legacy physical firewalls into software and cloud-delivered SASE, which stands for Secure Access Service Edge.
Wait, let's make sure we define that clearly for the listener. Because the perimeter of a company isn't what it used to be, right? 10 years ago, the perimeter was literally the 4 walls of the office building. You put a physical firewall at the internet connection of the building, and you were safe. But today, that perimeter has totally evaporated.
Oh, completely. It doesn't exist anymore. You have employees working from coffee shops in Berlin, connecting to cloud servers hosted in Virginia, accessing data stored in Tokyo. You just cannot route all of that global traffic back through a physical metal box in a corporate headquarters just to check if it's safe. It creates way too much friction. It slows the network to a crawl. So CC brings the network security perimeter to wherever the user physically is. The security check happens in the cloud, right at the edge of the network, before the user ever connects to the corporate application.
Which is incredibly complex to build.
Highly complex, but incredibly effective once it's running. So that's Strata. That's the first pillar.
Okay, so Strata covers the network traffic. What happens to the actual code and the infrastructure?
That brings us to the second pillar, which is Prisma Cloud. This is designed to secure multi-cloud enterprise code. When developers are building new applications in, AWS or Azure or Google Cloud, they're constantly spinning up new containers, new virtual machines. Prisma Cloud secures that code from the very moment a developer writes it, all the way to when it's running live in production. It embeds security directly into the development pipeline.
Got it. And then the third pillar, which I know we are going to spend a lot of time on later because it's arguably the most critical for their whole AI strategy, is Cortex.
Right, Cortex and specifically XSIAM. Cortex is their security operations platform. Think of it this way, even with great network security and great cloud security, things are still going to slip through. Alerts still get generated. Cortex is designed to replace legacy SIEMs.
And a legacy SIEM, for those who might not be deep in the weeds, is essentially just a massive, dumb central logging system.
Exactly. It just collects all the alerts from all the different tools and dumps them on a screen for a human security analyst to stare at all day. It's exhausting. XSIAM automates that modern security operations center, or SOC. It uses AI to ingest the data, detect the threat, and actually remediate it without waiting for a human to click a button. So to summarize the Palo Alto pitch, you have Strata for the network, Prisma for the cloud, and Cortex for operations.
Okay, let's unpack this for a second. If I'm visualizing this for you, Palo Alto's strategy is basically like building a massive, all-encompassing medieval fortress. You have the outer walls and the drawbridge, which is Strata, monitoring everyone trying to get in. You have the secure interior vaults for your precious assets, which is Prisma, and you have the central command tower running automated defenses across the courtyard, which is Cortex. Now, building that fortress is not a weekend project.
No, not at all.
It takes a massive amount of time to dig the moat, build the walls, integrate the different wings, and get the guards speaking the same language. But the pitch they are making to the CIO is incredibly compelling. They're saying, once you are inside this fortress, you have everything you could possibly need. You never need to leave, and you never need to hire a sketchy outside contractor to build an extra wall. It's total enterprise consolidation.
Yeah, but that fortress analogy perfectly highlights the inherent friction in Palo Alto's model.
Yeah.
Because while Strata, Prisma, and Cortex do integrate beautifully with each other, they are still fundamentally separate, massive software architectures.
Right.
They often require completely different procurement frameworks to buy. They require different engineering teams to deploy. The network guys deploy Strata. The DevOps guys deploy Prisma. And the security analysts deploy Cortex. Building a fortress is a massive, highly disruptive undertaking for a company. It's very heavy lifting.
Now, contrast that heavy lifting with CrowdStrike's approach, which, honestly, looking at the technical papers, feels like it's coming from a completely different universe. CrowdStrike does not build fortresses. They sell what they call the Falcon platform. And the core differentiator here, the absolute foundational element we really need to understand, is what they call the single lightweight agent.
Yeah, this is the defining architectural difference of this entire rivalry. CrowdStrike protects enterprises from the endpoint upward. And an endpoint is literally any device that connects to the network. A laptop, a mobile phone, a server in the cloud, even a point-of-sale register at a retail store. So instead of deploying heavy network hardware or bolting together three massive platforms, CrowdStrike just installs one single microscopic piece of software, the agent, onto every single endpoint in the company.
I really want to emphasize the word microscopic here. We are talking about an agent that consumes almost zero computing power. You, the user, don't even know it's there. It doesn't slow down your computer like, the old legacy antivirus software from the early 2000s that would just completely freeze your machine while it ran a scan.
Right, the old McAfee pop-ups.
Yeah.
No, this operates silently at the kernel level of the operating system. And here is the magic of that single agent. It doesn't just sit there waiting for a known virus to execute. It streams real-time telemetry continuously into CrowdStrike's centralized cloud architecture, which they call the threat graph. We are talking about trillions of data points. Every single time a process executes, every time an IP address connects, the agent observes it and sends metadata to the threat graph.
The threat graph. I absolutely love this concept. It is essentially a global AI-powered nervous system.
It absolutely is. It harnesses what they literally call the power of the crowd. Let's say a highly sophisticated state-sponsored hacker group launches a completely novel zero-day attack. A zero-day is a weaponized piece of code that the world has never seen before. There's no patch for it. They target a single laptop of a mid-level manager sitting in an obscure coffee shop in Berlin.
Okay.
The Falcon agent on that specific laptop observes the software behaving strangely. It notices the software trying to escalate privileges or move laterally across the system. It immediately flags the anomaly, sends the telemetry up to the threat graph. The AI analyzes it, categorizes it as malicious, kills the process on the laptop in Berlin, and then here's the incredible part, within milliseconds, every single other CrowdStrike agent on the entire planet is automatically updated to block that exact attack.
It's true herd immunity. If one person gets sick, the entire global population gets the vaccine 3 seconds later. And here's where it gets really interesting for me, and where I want to offer another analogy for you to weigh against the Palo Alto fortress. Instead of a massive fortress, CrowdStrike is essentially giving every single endpoint in your company a microscopic multi-tool, like a digital Swiss Army knife. You don't build new walls, you just download a new software module to the tool you already have. Let's say you're an IT manager and you realize, hey, we are getting hammered by credential theft. I suddenly need identity protection. Or I need next-gen SIEM for log management. With Palo Alto, you might be looking at deploying a whole new platform architecture. But with CrowdStrike, because that single agent is already installed on the laptop, there is zero new software to push to the machine. The agent is already there. You literally just log into your Falcon Cloud dashboard, check a box for identity protection, and instantly that capability is activated. The multi-tool just suddenly grows a new blade.
Yeah, that frictionless activation is the absolute core of CrowdStrike's consolidation thesis. They do not sell separate software systems. They sell modules that unlock capabilities within the system you already have running. Their argument to the enterprise CIO is simple. This single-agent system carries a vastly lower total cost of ownership. It requires a fraction of the engineering manpower to operate compared to Palo Alto's sweeping multi-platform deployment. You deploy the sensor once, you ingest the data once, and you reuse that exact same data stream across multiple security functions. Endpoint protection, cloud security, identity, log management. It's extraordinarily elegant from an engineering perspective.
So if we look at the board right now, we have PANW pushing the multi-platform fortress and CRWD pushing the single-agent microscopic multi-tool. Both are aggressively trying to achieve total enterprise consolidation. Both want 100% of your security budget. But how do these fundamentally different architectures actually change the way these companies sell to customers? Because you cannot sell a heavy, complex fortress the same way you sell an instantly activated multi-tool. And this leads us directly into our forensic market capture audit. Let's look at their go-to-market playbooks and the massive friction of conversion.
Right, because to really understand the go-to-market strategy, you have to put yourself in the shoes of the enterprise CIO they are pitching to. When Palo Alto walks into the room, they face massive mechanical friction. Remember, the CIO already has 30 different security vendors. They have a contract with Checkpoint for their firewalls. They have a contract with Fortinet for their network security. They use Splunk for their log management. And all these contracts have completely different expiration dates.
Which is a logistical nightmare.
Exactly. So if the Palo Alto sales rep says, hey, buy our massive 3-platform fortress to replace everything, the CIO's immediate logical response is going to be, I can't. I'm legally locked into a contract with Splunk for another 2 years. I'm locked in with Fortinet for 18 months. I don't have the budget to double pay for security software. Come back in 2 years.
Right. It is the ultimate enterprise roadblock. The budget is literally locked up. Even if the CIO loves the Palo Alto technology, their hands are tied by the CFO. So how does PANW break that deadlock? How do they force the replacement of a competitor like Checkpoint or Fortinet today rather than waiting 2 years? Because the financials detail a fascinating, highly aggressive maneuver they call platformization promotions.
It is an incredibly aggressive financial strategy. Palo Alto essentially goes to that CIO and says, look, we know you are stuck in a contract with Splunk for 2 years. We want you to start building the Cortex Fortress today. So we will give you our software for free or at a deeply discounted runway rate for the next 2 years. We will eat the cost of protecting you right now, so that you can burn down your existing legacy contracts without paying twice. They are structurally forcing the legacy replacement by absorbing the financial friction of the transition entirely onto their own balance sheet.
Wait, hold on a second. Let's pause right here because this is where my alarm bells go off as a financial investigator. You're saying they literally give away a multi-million-dollar flagship platform for free. How does their board of directors approve that without firing the CEO immediately? Isn't giving away your product a terrible business model in the short term? You are basically vaporizing your own immediate revenue generation.
It is a massive risk, yes. And you are absolutely right that it creates intentional, severe short-term billings headwinds. When Palo Alto executes one of these platformization promotions, their immediate recognized revenue takes a hit. The top-line growth visibly slows down. But you have to look at the long-term mathematical impact. They are not a charity, right? They aren't giving it away forever. They are doing it to secure massive, multi-year, multi-million-dollar contractual commitments that officially kick in the moment those legacy contracts expire.
Okay, so it's a delayed gratification play.
Exactly. Look at the psychology and the structural lock-in. Once an enterprise spends a year transitioning their network to Strata, their cloud to Prisma, and their operations to Cortex, displacing Palo Alto becomes a logistical nightmare. It can take up to 3 years of engineering time just to rip out that architecture. It is total, unshakable enterprise lock-in.
Okay, so they are taking a deliberate punch to the face today to guarantee a monopoly on that customer's budget tomorrow. And if we look at the hard data from their Q3 fiscal 2026 earnings, the strategy is undeniably working. They secured 110 net new platformizations in just that one single quarter. That brings their total to approximately 2,280 fully platformized enterprise customers. And management has drawn a massive line in the sand for Wall Street. They are explicitly targeting 4,000 platformizations by fiscal year 2030. They believe that hitting that 4,000 number will drive $20 billion in next-generation security ARR. $20 billion. That is an astronomical revenue target built almost entirely on the back of absorbing short-term pain for long-term fortress dominance.
It is a highly calculated bet on their own scale and their ability to endure that financial friction. Now, contrast that with CrowdStrike. We just detailed Palo Alto's agonizing process dealing with contract expirations and free software runways. CrowdStrike avoids this friction almost entirely through what they call module cross-selling and their consumption model, Falcon Flex.
Right, because once that microscopic Falcon agent is installed, which usually starts as just a basic endpoint antivirus replacement, there is no massive architectural deployment hurdle to get the customer to buy more things. Activation is instant. There's no need for a massive promotion to cover a 3-year deployment cycle because there is no deployment cycle. But how do they actually monetize that speed? They use a consumption model. Let's explain Falcon Flex, because this completely bypasses that CFO roadblock we talked about earlier.
Yeah, Falcon Flex is brilliant in its simplicity. And it mimics how cloud providers like AWS sell their services. Think of it as an enterprise credit system or like a prepaid gift card. Historically, every time an IT manager wanted to try a new security feature, they had to go to a procurement committee, write a formal RFP, justify the budget, and sign a new contract. It takes months. With Falcon Flex, the enterprise signs a large annualized commitment upfront. They buy a massive pool of funds. Then dynamically, as their threat landscape shifts week to week, they can spend those funds to instantly spin up new cloud-delivered modules on the agent. Want to try next-gen SIEM? Click the button, the funds are automatically deducted from your Flex balance, and you are protected instantly.
It's frictionless consumption. You don't have to ask the CFO for permission to buy the identity protection module because the money is already in the Falcon Flex account. The budget is already approved. This entirely bypasses the traditional agonizing procurement friction that slows down software adoption. And the data in the Q1 2027 report proves this is an absolute hyper-growth engine for them. Look at their module-based cross-selling success. The filings show that 25% of their customers have already adopted 8 or more Falcon modules. Think about the gravity of that statistic. A quarter of their entire client base isn't just using them for one or two things. They are deeply integrated into at least 8 different functional areas of the platform.
And this Falcon Flex model allows them to close massive complex deals rapidly without the long runway of a Palo Alto promotion. The data cites CrowdStrike closing massive 8-figure deals worth over $10 million, using Falcon Flex with major global fuel retailers and high-performance AI chip companies. When you remove the friction of installation and you remove the friction of procurement, the velocity of your sales just skyrockets. But, we have to recognize that this rapid acceleration of module adoption carries its own risks.
Yeah, what's the downside?
Well, if you're selling based on frictionless speed, it requires absolute operational perfection from the software. Furthermore, it risks higher sales force churn if the land and expand motion isn't managed carefully, because sales reps are constantly having to push new modules to existing clients to hit their quotas, rather than just landing one massive fixed contract and walking away like they might at a legacy vendor.
So let's step back and look at the board again. We have PANW taking a short-term financial hit, giving away software to structurally force legacy vendors like Checkpoint, Splunk, and Fortinet out the door, all to build long-term fortress lock-in. And we have CRWD growing frictionlessly, handing out prepaid Falcon Flex credit cards to customers to instantly activate new tools on their single agent. How does this strategic divergence actually manifest on their balance sheets? Because ultimately, these are publicly traded companies and investors demand cash. This leads us to the margin expansion audit and what we call the backlog paradox.
Let's start by reconciling their forward-looking pipelines, which reveals the backlog paradox perfectly. In software accounting, the main metric we use to measure future pipeline health is called RPO, or remaining performance obligations. For those unfamiliar, RPO tracks the total contracted revenue that a company has legally secured from a customer, but has not yet recognized on the income statement because the service hasn't been fully delivered yet. So if I sign a 3-year contract with you today for $300,000, but I only pay you $100,000 a year, that entire $300,000 goes into your RPO backlog right now. Between these two titans, there's a combined $27.2 billion in RPO sitting on their balance sheets. But the distribution of that backlog tells the entire story of their opposing strategies.
The numbers here are truly staggering, but they require deep context. Palo Alto reports a massive $18.4 billion in RPO, which is up 36% year over year. CrowdStrike, on the other hand, reports an RPO of $8.8 billion. Now, if you just looked at those two top-line numbers in a vacuum, you might think Palo Alto is twice as successful or twice as large. But why is PANW's backlog so much heavier? I mean, it isn't just because they are an older company, right?
No, it's totally structural. That $18.4 billion RPO is the direct mathematical consequence of those platformization promotions we just discussed. Remember, they are signing massive multi-year contracts where they might not bill the customer heavily in the first year while the legacy contract burns down, but the customer is legally committed to paying them tens of millions of dollars in years 2, 3, and 4. All that future contracted revenue piles up in the RPO bucket. It's a massive reservoir of locked-in future cash. It's the financial manifestation of the Fortress strategy.
It's essentially a massive $18.4 billion IOU from the Fortune 500. It guarantees their revenue stream for the next half-decade. So why does CrowdStrike have a much smaller RPO, and what metric are they prioritizing instead to prove their growth?
CrowdStrike's $8.8 billion RPO is highly respectable for a company of its size, but because their Falcon Flex model and modular upsell strategy allow for instant activation and much faster billing cycles, they do not build up the same massive multi-year deferred revenue reservoirs in quite the same way. They don't need to give away 2 years of runway. Instead, CrowdStrike focuses heavily on ARR, or annual recurring revenue, to judge its operational momentum. And their core ending ARR reached $5.51 billion, fueled by a record addition of $256 million in net new ARR during just the Q1 2027 quarter alone.
And net new ARR is basically the holy grail for SaaS companies.
It absolutely is. It measures exactly how much new recurring business you added in a 90-day window. Adding $256 million in a single quarter highlights their premium operational velocity. They're adding recognized recurring revenue at a blistering, frictionless pace.
Okay, so PANW has the massive locked-in future backlog of 18.4 billion, and CRWD has the frictionless, hyper-accelerating current recurring revenue stream. But what does this all mean for their actual cash generation? Let's do the margin expansion audit and isolate how these companies actually generate real cash.
This is where Palo Alto's financial engineering becomes truly remarkable. We established that they are utilizing aggressive promotions, essentially giving away expensive software in the short term. Logically, if you were giving your product away, you would expect your profitability to tank.
Right.
But it doesn't. Palo Alto generates an elite 38.5% trailing 12-month adjusted free cash flow margin. In raw dollars, that is $4.08 billion in pure free cash generated over the last year.
I have to stop you there because that number defies basic logic. $4.08 billion in pure cash generated, representing nearly 40 cents on every single dollar of revenue they bring in. How is it mathematically possible to maintain a 38.5% margin while actively burning down competitor contracts with free software? It sounds like they are breaking the laws of financial physics.
They aren't breaking the laws. They are leveraging the physics of scale and product mix. Palo Alto is a massive enterprise generating $3 billion in total quarterly revenue. Yes, they are taking a hit on the margins of the new software platformizations, but they still have a massive, highly profitable legacy business running in the background. Remember those physical firewalls we talked about earlier, the metal boxes?
Yeah.
They still sell them. They generated $594 million from legacy hardware products this quarter alone. That legacy hardware acts as a cash cow. It subsidizes the software promotions.
Oh, wow. So the old world is literally paying for the conquest of the new world.
Exactly. Furthermore, as more customers finally transition to their next-generation security platforms, which grew 30% year over year to $4.15 billion in ARR, the underlying software gross margins begin to take over. Software is inherently high margin because it costs almost nothing to duplicate. Their massive scale allows them to absorb the temporary hit of acquiring a new platformization customer without materially denting their overall cash generation. In fact, management is so confident in this underlying math that they have targeted a 40% free cash flow margin by fiscal year 2028.
So Palo Alto's cash generation acts as this impenetrable valuation cushion. They are a cash-gushing value compounder. They can afford to be patient. Now let's look at CrowdStrike's market mechanics, which are entirely different because they don't have metal boxes to sell.
Right. CrowdStrike's profitability is fueled purely by the high-margin SaaS economics of its single-agent Falcon platform. In Q1 2027, they delivered a 34% free cash flow margin, generating a record $468 million in cash from operations for the quarter. Because they don't have legacy hardware lines with all the associated supply chain costs and manufacturing overhead, their entire business model is built on highly efficient, frictionless software delivery.
And if you are looking at their balance sheet, this brings us to the famous Rule of 40, which is a metric that institutional software investors absolutely obsess over. As a quick reminder for you, the Rule of 40 is a simple calculation used to evaluate the health of a software company. You take their revenue growth rate percentage and add it to their free cash flow margin percentage. If the combined number is over 40, the company is considered an elite SaaS business, proving it can balance rapid growth with actual profitability. Hitting 40 is hard. Where did CrowdStrike land?
CrowdStrike's Rule of 40 score hit an exceptional 59%. Let me break the math down really quick. Their revenue grew at 26% year over year to $1.39 billion. And you add that 26% growth to their 34% free cash flow margin. Hitting 59% is incredibly difficult at their scale. It demonstrates mathematically that their frictionless modular upsell model isn't just growing top-line revenue at a massive clip, it is highly accretive to the bottom line. Every new module they sell drops pure profit to the bottom line because the agent is already deployed on the device.
To summarize this forensic financial audit, Palo Alto trades at a value-oriented free cash flow multiple because it's navigating a complex transition from legacy hardware to software, but it leverages its massive scale to maintain elite 38.5% FCF margins, generating $4 billion in cash and locking in an $18 billion backlog. CrowdStrike, meanwhile, trades at an elite premium growth multiple because it operates a pure-play, high-margin SaaS engine, pumping out a 59% Rule of 40 score fueled by the Falcon platform.
Precisely. They have the cash, and they have the architectural foundations firmly established. But, a war isn't won by looking at the past. It's won by preparing for the future. And the future of cybersecurity is currently undergoing a seismic, terrifying shift. Which brings us to the next evolution of this dual AI platform ingestion and the modernization of the Security Operations Center.
This is the part of the analysis where the science fiction really becomes brutal reality. We need to map out the structural tailwinds powering their AI-driven SOC modernization. Let's start with the threat landscape itself, because the technical briefings outline a terrifying picture of what is coming. They explicitly mention the rise of frontier AI models, specifically citing a model called Mythos. What actually happens when the hackers get their hands on enterprise-grade AI?
The emergence of models like Mythos changes the entire paradigm of corporate defense. Historically, cybersecurity was largely about patching known vulnerabilities, right? If a security researcher found a hole in a software system, the vendor would issue a patch, and the security system would look for anyone trying to exploit that specific known hole. It was reactive. But frontier AI can autonomously scan code, find novel vulnerabilities that no human has ever seen, write the exploit, and deploy it at a speed and scale that is simply impossible for human analysts to track.
I was reading through the strategic presentations, and they make a terrifying point. Securing known vulnerabilities is just no longer enough. Defense requires real-time AI. The timeline of an attack is compressing drastically. It used to take days for an attacker to move laterally through a network after a breach. Now, that timeline is compressing down to minutes or even seconds. If you rely on a human sitting in a security operations center staring at a screen waiting for an alert to pop up so they can manually quarantine a device, well, you have already lost. By the time the human clicks the mouse, the AI has already breached the network, extracted the data, encrypted the servers for ransom, and covered its tracks. To fight AI, you have to use AI. So how are our two titans arming themselves for this AI arms race? Let's look at PANW's AI arsenal first.
Palo Alto is positioning its Cortex XSIAM platform as the ultimate autonomous weapon here. Remember, XSIAM is designed to rip and replace those legacy SIEMs. Legacy SIEMs just aggregate logs. They don't take action. XSIAM is an AI-driven automation engine. Because Palo Alto has that massive multi-platform fortress, XSIAM can ingest data from the network edge, from the cloud infrastructure, and from the endpoint simultaneously. It analyzes all of that context and resolves alerts autonomously. It doesn't just tell the human there's a problem. It isolates the device, blocks the IP address, and stops the malicious process before the human even knows it happened. And the financial data shows this is resonating with CIOs. Cortex XSIAM is scaling massively, reaching over $600 million in ARR.
That is explosive growth for a relatively new product category. And Palo Alto is also going on the offensive with how they protect a company's internal AI tools. They have a platform called Prisma ARRs, which is an AI-centric security cloud platform built specifically to protect AI applications and agentic endpoints. Let me give you a mind-blowing example from the data to illustrate this. There is a global consulting leader that selected Prisma ARRs to secure their internal AI applications. Those applications are currently consuming over 2 trillion monthly tokens.
Think about the sheer scale of that telemetry. 2 trillion tokens a month flowing through an enterprise's AI applications. Every single one of those prompts and outputs needs to be monitored.
Right.
And what are they looking for? They're looking for prompt injection attacks where a malicious user tries to trick the AI into revealing sensitive internal data. They are looking for data exfiltration, or malicious agentic behavior, where the AI starts executing unauthorized code. Palo Alto's core argument is that because they have visibility across the entire fortress, the network with Strata, the cloud with Prisma, and the operations center with Cortex, their AI has richer, more holistic data to train on. They argue that fragmented point products that silo data increase latency, and therefore their sweeping platformization is the only sustainable answer to combat machine-speed AI threats.
Their pitch is essentially fragmented cybersecurity is the enemy of AI defense. That is a powerful narrative. But CrowdStrike has a very different philosophy on how to deploy AI, centered around what they call their agentic SOC strategy. How does the microscopic multi-tool fight a frontier AI model like Mythos?
CrowdStrike's approach is deeply embedded in its single-agent architecture. They leverage what they call Charlotte AI. Now, Charlotte AI isn't a separate, massive platform you have to buy and install. It is an agentic AI engine woven directly into the fabric of the existing Falcon platform. It delivers autonomous security decisions within customer-defined guardrails. Its primary job is to act as a hyper-intelligent assistant. It triages detections, drastically reduces the noise of false positives, and accelerates the response time, bridging the critical skills gap for security teams who are currently just drowning in alerts.
And Charlotte AI is paired directly with their next-gen SIEM, which they call Falcon Log Scale. By integrating next-gen SIEM and Charlotte AI directly onto the single agent that is already on the laptop, they are driving a massive 3x year-over-year increase in module ARR. Because the data is ingested once by the single sensor on the device and analyzed natively within the Threat Graph cloud, CrowdStrike argues their AI is inherently faster and more efficient than having to pass data between three different massive platforms like Palo Alto does.
Furthermore, CrowdStrike recognizes that they cannot fight the AI wars entirely alone from the endpoint. They recently launched an industry-first coalition called QuiltWorks. This is a massive strategic cybersecurity partnership. They are teaming up with hyperscalers like AWS and leading AI development labs like OpenAI and Anthropic, alongside massive integration firms like Accenture and IBM. The goal of QuiltWorks is to secure frontier AI models and infrastructure collaboratively at the foundational level. CrowdStrike is basically embedding its security philosophy directly into the fabric of the AI developers themselves.
So if we synthesize the AI strategies, we have PANW using its massive holistic scale to build an automated, all-seeing AI SOC with XSIAM scaling to 600 million in ARR and tripling its Prisma Air's customer count. And we have CRWD embedding autonomous agentic AI directly onto the endpoint with Charlotte AI and their next-gen SIEM, driving a 3x increase in module ARR and building massive coalitions with the AI creators. Now, this level of innovation requires staggering amounts of capital.
Massive amounts.
The research and development costs to stay ahead of frontier AI models must be astronomical, which brings us to the crucial topic of capital allocation, moats, and what the financial world calls the share cannibal playbook. How do these companies leverage their structural financial power to build wider, deeper moats?
When we look at capital allocation, we see the absolute clearest manifestation of Palo Alto's status as a value compounder. They have $4.08 billion in free cash flow to deploy every single year. They use this massive gushing cash generation to self-fund a highly programmatic mergers and acquisitions playbook. They're the ultimate share cannibal. They don't just use cash to buy arbitrary revenue growth, they use cash to buy strategic puzzle pieces to expand their fortress without diluting their shareholders with massive new stock issuances.
Let's look at the specific M&A examples in the analysis. Palo Alto recently acquired and integrated two major platforms, CyberArk and Chronosphere. And what did those acquisitions buy them? It expanded their reach into massive, highly lucrative addressable markets like identity security and observability. Remember those 110 net new platformizations we talked about earlier? 20 of them came directly from integrating CyberArk and Chronosphere. And financially, those two acquisitions alone contributed a staggering $1.8 billion to Palo Alto's total RPO backlog.
Exactly. They use their cash to buy a best-in-class company, completely rip out its standalone sales motion, integrate its core technology directly into the platformization strategy, and then instantly cross-sell it to their massive enterprise base. It is a brilliant capital loop. However, because Palo Alto is still managing a legacy hardware transition, they're still heavily reliant on selling those physical firewalls that are subject to macroeconomic supply chain shocks and corporate hardware refresh cycles. The market values them differently. They trade at a more value-oriented multiple, roughly 27 times enterprise value to free cash flow. That multiple reflects the perceived drag of that legacy hardware business, despite their elite compounding software execution.
Right. It's the heavy anchor of the old world subtly holding back the valuation of their new world. Now look at CrowdStrike's capital allocation. CrowdStrike doesn't have a legacy hardware business dragging it down. They don't sell metal boxes. They demonstrate their capital strength through organic hypergrowth and maintaining a pristine fortress balance sheet.
CrowdStrike's lightweight software model allows them incredible operational agility. They don't just protect the massive Fortune 500 companies, though they certainly protect hundreds of them. Their lack of hardware requirements means they can effortlessly sell down into the small and medium-sized business sector and the mid-market. They self-fund their growth organically, maintaining that elite 59% Rule of 40 score. And when they generate that $468 million in quarterly cash flow, they use it to strengthen their own balance sheet, such as paying down their senior notes and debt obligations. This demonstrates their ability to scale indefinitely without diluting shareholders or relying on debt markets.
They are an absolute operational momentum machine. But, and this is a big but, no company is invincible. No strategy is flawless. If you are a CIO betting your company's survival on one of these vendors, or if you are an investor allocating your capital, where are the cracks in the armor? We have to impartially synthesize the comparative investment case and outline the severe execution risks for both titans. Let's deliver the final verdict.
The verdict structurally is very clear. Palo Alto Networks represents the risk-adjusted value compounder. They lock in total enterprise architecture, they generate unmatched cash flow to self-fund programmatic M&A, and they offer a valuation margin of safety. CrowdStrike represents the premium operational momentum play. They dominate the cloud with frictionless, hyperscalable software, but their premium valuation leaves absolutely zero margin for error. Any stumble is catastrophic to their stock price.
And the errors are the risks. Let's start with Palo Alto's execution risks. The analysis points to two massive hurdles. First, the macro headwinds potentially compressing their legacy hardware pricing power. If the global economy tightens, interest rates rise, and CIOs decide to delay their physical firewall refresh cycles by another year, Palo Alto's hardware revenue, which was still almost $600 million this quarter, could stall. That creates a massive anchor on their overall top-line growth. Second, and perhaps more existential, is the danger of M&A integration bloat.
Yes. While buying a company like CyberArk and Chronosphere adds $1.8 billion in RPO, absorbing high-growth software adjacencies creates immense operational complexity behind the scenes. Integrating different code bases, merging completely different engineering cultures, and forcing different user interfaces into a supposedly seamless three-platform fortress is incredibly difficult. If Palo Alto fails to integrate these acquisitions smoothly, the technology breaks down. They risk recreating the exact vendor fatigue inside their own platform that they are actively promising to cure.
The fortress basically becomes a labyrinth where nobody knows where the keys are.
Right, exactly.
And what about CrowdStrike? Their risks are arguably more acute, precisely because of their architecture. The primary execution risk revolves entirely around their single-point dependency. Because they rely on a single highly privileged software agent running at the deepest kernel level of millions of devices, their operational momentum requires absolute, frictionless, 100% perfection.
This is the double-edged sword of the single agent. Having access to the kernel level of an operating system is a superpower. It allows you to see everything and stop anything. But if something goes wrong at the kernel level, the entire machine dies. The analysis explicitly flags the ongoing legal and customer retention fallout following the July 19 incident. When you bypass the friction of massive platform deployments to push instant automated updates via the cloud directly to the kernel, any disruption is catastrophic. A single bad line of code pushed to that single Falcon agent can literally blue screen a global enterprise, grounding airlines, and freezing banks. Any major disruption shatters their core foundational thesis of frictionless reliability. And because they trade at such an elite premium multiple, the market severely punishes any stumble in execution.
Which brings us back exactly to where we started. Imagine that CIO sitting in the boardroom facing the Frankenstein monster of 40 different fragmented security tools. They are exhausted by vendor fatigue. They are terrified of frontier AI models like Mythos attacking at machine speed. They know they need to consolidate.
And both Palo Alto Networks and CrowdStrike walk into that exact boardroom with the exact same promise: give us everything. Consolidate your entire digital defense under our banner. We will give you a single pane of glass to fight AI with AI. Palo Alto wants you to move your entire digital life into their multi-platform fortress. CrowdStrike wants you to install their single-agent operating system on every device you own.
And that leads to a deeply provocative thought, something for you to mull over as you analyze these two titans and watch this industry evolve. As we willingly consolidate our entire digital defense under a single vendor and a single pane of glass to fight AI with AI, as we put all our eggs in one basket, are we ultimately curing vendor fatigue, or are we just creating the ultimate catastrophic single point of failure? Something for you to think about until our next deep dive.